Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back at the end of the week for another weekly market recap. These usually feature my good friend Lance Roberts, but he's away today, and we are joined by his colleague, Michael Leibowitz. Michael, thanks so much for joining us today.
Thank you for having me. It's great to be on again.
Great. Well, it's wonderful to have you back on. As I like to say, it's really an upgrade with Lance gone. So thanks
we
for
all
doing
know that. Except for Lance, we all know that.
I think in his heart, Lance knows it too. All right. Well, looking at the markets this week, we actually have an up week in the markets here. In fact, there's a pretty big update today. What's driving this positive action?
Some of this is reflexive, and some of this is because the Fed's stance is we're getting closer to a change in stance. So by reflexive, I mean the market was just grossly oversold about 3 or 4 weeks ago and was due for a bounce. We've been calling for a bounce for a few weeks. That bounce kind of happened when we thought it would have happened, but it was really slow to start. A lot of ups and downs. But over the last week or two, it's really gained some strength. We're up almost 10% on the S&P. And shockingly, the Dow has had its best October ever. Barring a Halloween massacre, it will be the best Dow Jones October ever, believe it or not.
Wow.
So, we were oversold, and those shorts are having a cover. The question is why? I think a lot of it is just technical. We got too overdone to the downside. So now we're bouncing. We're going to get too overdone to the upside. If you want rationales, excuses, newspaper always likes to have a reason for every time the S&P moves. I would put the reason as the Fed is getting closer to the end game, which by definition is always going to happen, whether they're raising rates or lowering rates. As soon as they start moving, they get, by default, you're getting closer to the end game. So the Fed funds market is pricing in a 5% Fed funds. That's based on what the Fed has said. That's about where they think they're going to get to. They're going to do 75 next Wednesday. Then they're going to do probably 50 or 25s into late this year, early next year. And you get somewhere 4.25%. Maybe 5.25% on the outside. But the market loves to use the word pivot. Pivot seems to be the market's way of saying the Fed's going to turn around and start lowering rates and be friendly again. That's not what's going to happen. The Fed is going to stall. We talk about lag effects. It takes a long time for interest rate hikes to affect the economy for a number of reasons. Some of it is just data lag. It takes a while to collect data and to report on data. Others are that it just because car rates or mortgage rates rise, a lot of people weren't in the market a month ago. They are now. So for it to affect everyone, corporate borrowers, you name it, it takes a long time for interest rates to hit the economy. And it's estimated that's anywhere from 3 months to a year, depending on what you're looking at. So, what are we, late October now? Right now, we're looking at those interest rate hikes from March, April, May are starting to weigh on the economy. Forget about the ones that have happened since then, though that still will hit on the economy. So the Fed, if I'm the Fed, I say, you know what, let's stop here. Let's get it to 5%. Let's maintain a very hawkish rhetoric because we do care about inflation above all else. But let's just stop and wait to see. We did all this work. Let's see what the fruits of our labor are. So I think somehow the market is misinterpreting stalling with pivoting.
Got it. So rather than a pivot, you see a pause, right? Where they're basically just stop hiking. Yeah. A couple of questions on that. One is if they do indeed pause, what do you think happens with QT? Is it stay on autopilot in terms of the $95 billion a month coming off?
I think the Fed desperately wants to get their balance sheet down. I think to some degree, they realize they've done too much, a year too late, but they realize they did way too much. And I think to some degree, they think they did too much in the aftermath of the financial crisis. It's an emergency tool and it was used for non-emergency purposes. So I think they want to get their balance sheet down. And as long as they can keep getting it down without pulling too much liquidity from the financial markets and breaking something, as we like to say, they will stay on QT. I think it's for now, it's interest rates that are kind of the main focus for what the Fed will or won't do.
All right. Well, that's actually pretty interesting. I interviewed Pedro da Costa, who is a journalist who's covered the Fed for a couple of decades for institutions like Reuters and the Wall Street Journal, and he was saying that he sees that QE as a stimulative tool could be retired from the Fed toolkit. He echoed your sentiments there, and he talks to the policymakers at the Fed, all day long. That's what he does for a job. And the impression he has is that they feel like it sort of became more trouble than it was worth. It did more harm than it did good for them. And so it probably will still be an emergency funding vehicle in a true crisis, but really more, I think, is originally intended kind of like a very short-term lending facility to important institutions that are, in danger of going under. It's not going to be this sort of just ongoing pump of liquidity into the markets or into the system month after month after month.
Right. And just so our viewers are aware, before QE, before 2008, when they introduced QE, the Fed was buying and selling securities. It was called open market operations. And they would do these open market operations to help keep the Fed funds rate exactly where their target was. The Fed sets the Fed funds rate, but they don't it's not by decree. They use the market to make sure that when banks borrow from each other, it averages the average execution is at the Fed funds rate. So historically, they've always been buying and selling assets, treasury security assets in the markets. What's different about QE is that they were just massively accumulating assets, not necessarily for the purpose of keeping Fed funds pegged, but actually as an additional amount of stimulus to the markets. So I think Pedro is partially right. My guess is QE will be used again, but I think much more sparingly than we've seen it, and not necessarily just for a crisis. They may use it from time to time to boost the economy or even to boost the markets, right? I think if the S&P is down 40 or 50% come early next year, QT is going to go away and QE is going to come back into the potentially come back.
Okay. One of the things that I asked him, I'm trying to remember if he brought it up without me having asked him, but sort of a sense that, hey, it actually does contribute to this wealth disparity that we've seen really erupt in the country. And so again, the thinking there, we'll see what the future brings, but the thinking there is hey, we've kind of created a bad issue on wealth disparity, and we don't want to continue doing that with QE if we can avoid it. But
I think that's absolutely right. It's essentially money printing that goes right into the markets. And who owns stocks? It's the upper 10%.
Right.
That's where the wealth is. But if you kind of break down, I think Pedro's right. And if you break down what Pedro is saying, he's telling you that valuations are too high. The Fed doesn't want them this high. It creates too much wealth inequality. So it's there's a lot to unpack in that message. I think it's potentially, if that is what the Fed is thinking, and there are reasons to think they are, because a lot of what's happened over the last 30, 40 years can be blamed on the Fed. And as far as wealth inequality goes. So if the Fed is genuinely trying to take steps, that would be the first step I would do to bring back, make wealth more equal among all the classes, would be to get rid of QE, bring asset valuations back to historical norms.
Yeah, and that's interesting, which is, I guess I'll just ask the question, which is, and you're speculating here, but is that part of what you think is going on right now, which is a deliberate engineering of wealth amongst the higher end of the spectrum? Right. Let's try to make the rich a little bit less rich through what we're doing here, and therefore reduce the societal inequality at least a little bit. Because I think most people, myself included, have been thinking, no, they're just sort of trying to keep the system together right now. But maybe, I don't know. Do you suspect that there might actually be sort of a societal benefit angle to the policy here?
I think a little bit, right? Ben Bernanke is the one that told us that QE is a trickle down theory, right? You give the money, basically give all the money to the rich and let it trickle down to the lower classes. So what makes that question hard is Powell. If it was Lael Brainerd, who's the vice chair, she's very liberal, very
Hmm.
Democrat leaning. I would say there's a better chance of that. If it was Janet Yellen, I'd say there's a better chance. Powell is, I believe he's a registered Republican. So I don't know what to think. But I do think they realize they've distorted markets. And when you distort markets, you inherently make them unstable. They want to make markets more stable. So the only way to make them more stable is to bring their valuations back in line with reality, with historical norms. And by doing that, you reduce the risk of financial crises in the future.
Right,
So
right.
it serves a lot of purposes. Really, you could say there's a societal purpose, a market stability purpose, and you're just trying to get all the juice out of everything they did back out of the market from the last 2 years.
Right, and those aren't mutually exclusive. And again, I've been of the mindset, which is that the Fed created a monster, painted itself into a corner, or whatever analogy you want to use, and got to the point where it said, we would love to unwind what we've done here, but every time we try to, the system seems to want to crash on us. But I
Right.
feel like now inflation has really given them the excuse to say, hey, we're going to start breaking some things here, but we're going to have to get inflation under control. So if you don't like it, take it up with the inflation monster, buddy. Um,
I think
so,
it's going to be a controlled break, though. I think that's what they're really trying to engineer.
well, right,
Yeah,
right, yeah. They're trying to create engineer the soft landing, which they've never been able to do, and most people who know
right,
the Fed doubt their ability to do it. But that's what they're going to try, right? And
right.
on that point, it's funny you mentioned the open markets desk at the Fed, because another recent interview I did was with Joseph Wang, who actually used to be a trader on the Fed's open market desk.
He's another DC guy.
Yeah, he is another DC guy.
So you got three of
And
them. You're doing well.
yeah, that's right. And folks, that's where Michael is located here right now. So he's much more sanguine on the Fed's odds for success here. And the big reason for that is he feels like the Fed has a lot more tools at their disposal now than they did pre-2008, and that they can kind of hold everything together. The crisis risk that Lance will talk about, or the financial instability risk, that people are saying that's going to force the Fed to pivot. He seems to think that no, they've got enough tools here that they can, and sort of like having enough monetary duct tape, that they can kind of just patch everything together as they're trying to engineer this slowdown and the bringing down of inflation. That they can hold everything together, kind of like a jalopy. Might bang, it might wheeze, but it's going to keep going. And then once they get inflation under control, then they can begin to take the duct tape off and create more official patches or more official fixes to what they had patched and whatnot. So I don't know. Some people might say, hey, he worked for the Fed. He's a Fed apologist, and he's got an unrealistic set of optimism around it. But others would say this guy knows the plumbing really well. So,
Yeah. So first of all, the guy's really smart. He's worth following, worth listening to. I really admire him. I think he has a lot to share on the topic. I think, though, some of that is wishful thinking. And if we want any evidence, let's just look to the UK. 2 weeks ago, the UK was bailing out their pension funds. Their pension funds were using leverage to buy British bonds, probably US bonds as well. And yields in England went up significantly. And next thing you know, these pension funds are at the risk of going under. So, explain to me how the Fed is going to bail out that situation, right? There are ways, but it's really hard to do when inflation's running at 7, 8, 9%, because everything you do at this point, regardless of whether it does or not, is going to be perceived to be stoking inflation. And the last thing you want to do, the problem with inflation is that when inflation is running above normal for a while, it gets ingrained in our behaviors. We start changing our behaviors, our purchasing patterns, what we ask for from work regarding wages. And that creates a circular loop. And there's been a lot written both from the Fed and outside the Fed on this wage price spiral that can be created from inflation. And the Fed is trying to stop that spiral before it starts. So, the problem the Fed has is, yes, they may have tools. I'm not sold that they do have the tools, but even if we want to live in this fairy tale world where the Fed can do everything they want, they can't stop perceptions. And if they do something that gets people to be scared about inflation, they got a whole lot of problems on their hands. Bonds will sell off much further. Stocks will sell off. Then you start dealing with all the leverage in the system will start collapsing. So I think the Fed has tools. They got more tools. They know how to use those tools, maybe a little bit better. But this situation is very different from anything we've seen. And when I say that, I mean 1970, 1980 as well. Because in 1970, 1980, there was no debt, very little debt. So that's a good and bad thing. The good thing was that Volcker could raise rates to double digits significantly and not really bankrupt the country. The part of Volcker's problem was he had to raise them so much because there wasn't that much debt that he was affecting. Today, it's the opposite problem. Every 25 basis points has a much more meaningful effect than what Volcker was dealing with.
Right.
And when we start dealing with this lag effect, the risk of being wrong, of over tightening, is much more significant, just solely because the amount of leverage and debt in the system today versus, even 10 years ago. The debt to GDP for just the federal government has doubled since the financial crisis. It's now, about 120%. That's unsustainable. And that's what this all comes down to. This, at the end of the day, is all a debt problem. We are way over leveraged. A lot of the debt isn't being used for productive purposes, meaning that it's not creating income to pay itself off. So you only need more debt to service the existing debt. And what's the best way to kill a Ponzi scheme is to, in this case, raise interest rates, because that's going to bankrupt everyone that just keeps rolling over debt. But it's a question of when does that debt roll over? And it doesn't all roll over today or tomorrow.
So who you sound like right now, Michael, is Lacey Hunt, which is great company to be mentioned. And
thank you.
We had Lacey speak at Wealthion's recent fall conference. This was back in late September. And he agreed with what the Fed is doing right now. He said, hey, look, they've got to get inflation under control. That is the big thing that's changed on the landscape. It's a big enough problem that the Fed has to take care of it right now. And that's what it should be primarily focused on. But when he had come on in past years, Lacey had talked about the massive deflationary crisis that the country is sliding into. And so, at the end of his presentation, I said, Lacey, it sort of sounds like you used to say we have this massive deflationary problem that we really don't know how we're going to solve. But we got to spend all our focus trying to figure it out, because it is definitely going to impact and define our destiny from here. But you're now saying that on the way to going to slay that big deflationary dragon, we had this inflationary dragon show up. So we got to kill that thing first. So it's sort of like, okay, so let's cross our fingers. Let's hope the Fed is right. Once they kill this inflationary dragon, they then have this massive deflationary one to go after next, right?
I think that's right. Look, Lacey knows this. He'll be the first to admit it, that the Fed knows how to create inflation, or the Fed and Treasury, right? It's the formula for inflation is not difficult. It's more money. The problem is more money isn't so easy. All money is lent into existence. Money starts with a loan. So what happened in 2019, 2020, 2020, 2021 during a pandemic, the government borrowed $7 trillion. That's new money. And unlike their typical spending habits, they basically dropped it out of helicopters. Everyone got checks. They were giving money to businesses. It was borrowed and spent almost instantaneously. And at the same time, the supply lines were shut down. The economy was shut down. I mean, it was truly an amazing shift in both the supply and demand curve lines at the same time. So the government here's what really scares me. The government has figured out how to slay that one dragon, the deflation dragon. And the answer is massive government borrowing accompanied by QE.
Right. Sorry to interrupt you. I want you to continue, but I'm just going to correct you. I don't think they figured out how to slay the dragon. I think they figured out how to just make him go away for a little bit.
Put him in his room.
Yeah.
Put him in his basement for a while. But you're right. I think the natural, assuming there's no government Fed interference, the natural dragon that's going to be the big problem is the one in the basement right now, the deflation, disinflation dragon. And that's a function of all the unproductive debt that we're saddled with. You can think of it as a massive tax on the economy. If I go, here's a great example. I go buy a third car for we only need two cars. I buy a third car convertible to drive around in. That's great. But that money I spent on that does not pay me back anything. I can't invest it in the economy. And I have to, of my paycheck now, some of that has to go to paying down the car. So it's a natural tax on the economy. Whereas if I would have invested that money in something, the money grew, I could then have money in the future to spend more and make the economy grow. So what we're dealing with is all these years, decades of poor spending decisions, both at a government level, corporate level, and even to some degree at a personal level. Corporations buying back stock instead of investing in the future of not only their company, but this country. So that's what we're saddled with. And that's why the deflation dragon is the one that keeps popping his head out and will eventually probably strike again. But the Fed invented this new dragon that they're now trying to slay, as you said. And the Fed now has the formula for this, almost like Frankenstein making dragons. They now have a formula to create that dragon. So you're right. This is tough times for the Fed and the government.
All right. So there's a bunch of things you said a few minutes ago I want to sort of dial through here with you. Just one quick question, though. So you said that they figured out that they can shove the dragon in the basement for a little bit longer, based upon the extreme measures they took in the wake of the pandemic. Here's the thing that I think just worries a lot of our viewers here, which is, how do they not think that we were going to get an immense and relatively immediate inflationary response to all of that, right? They traded off. Hey, we're all freaking out about the pandemic and the global economy being shut down, but in politicians, you give them a choice. They're gonna go print and give out money, as long as we let them, right? The Fed, though, is supposed to be, kind of the regulator, in the system, right? That says, hey, we can't go hog wild. We got to know that actions have repercussions here. And granted, the inflation didn't really start taking off until we had the fiscal stimulus alongside the monetary stimulus, but we had unprecedented monetary stimulus. The Fed is a big enabler of the government's ability to deficit spend, and so it enabled that. And then to the point you said earlier, they kept QE going way longer than they should have, while they were in the middle of pronouncements saying, this inflation's transitory, don't worry about it, right? So they were just colossally wrong. So, what should give us confidence that these guys are going to be any more successful going on future crisis or not?
You're 100% right. And I'm the biggest basher of the Fed and have been for a very long time. For the first time that I can even think of, I think the Fed is actually doing the right thing. Now, what concerns me is that they're only doing the right thing until there's enough pain, and then they're going to go back to doing the wrong thing. Mm-hmm. So, I agree with you. What they did, not necessarily right after the crisis. I understand that at some point you have to drop your economic textbooks and you have to save the country, like we did in World War II, like we've done in other times. You have to do what it takes to avoid a total collapse. But that what they did, what the federal government did, and then what the Fed did to back it up was well beyond what was needed. Not to say that there weren't people that needed help, companies that needed help. That's one thing. And we can debate that all day, how much or how little they should have helped. But where there's, I think, very little debate is everything they did in 2021 when the economy was healing itself and the amount of money the federal government spent. And then the Fed kept doing, like you said, kept doing QE. They kept interest rates at zero. They were buying mortgages. They weren't even buying treasuries. They were buying mortgages as it was a mortgage, as the house prices were zooming higher.
Right. 60 billion a month, right? I think is what they were doing every month, something like that.
Is that what it was?
Yeah, I think it was
something like that.
120 combined with treasuries, but half of that was going to mortgages.
Right. Why, this whole MBS mortgage thing started in 2008 because there was a housing crisis. And again, we can debate that all day, where they should or shouldn't have been doing that. But that should have ended in 2008, 2009. They bought mortgages in QE2 and 2012, 2014, 15. And now it's preposterous what they're doing and what they're thinking. So you're right. Like, should we trust them? We don't really have a choice, so we have to trust them.
Yeah, but we should be wary.
but this is the first time I've seen the Fed not bowing down to markets, where all of them, every Fed speaker, one after another, says, we don't see any financial crisis. We don't see any problems. The market's down 20, 25%. England's falling apart. China's in their markets intervening. You have the Euro region is, getting crushed. The Bank of Japan is trying to do QE at the same time they're battling inflation. I mean, the world's a mess in large part because of the dollar, because of the Fed. I mean, not in large part, but it's a part of it. So, I mean, if nothing else, these are fascinating times we're living through right now.
Well, they are, and it's why we have to be paying such close attention.
Absolutely,
for all the reasons I just said. Yeah, and even to the people who are running the show, because we just said we can't really trust them to do the right things because they've done the wrong things so often. Interesting, you mentioned the latest news about the Bank of Japan, which we'll get to in just a little bit. I want to stay on this main theme for a second, though, just because I think it's so important. I think it's really something just fundamental to be aware of, and I'm curious if you agree with me on this. I think you probably do, but like, if we just took our hands off the system, right? If the Fed just stopped doing whatever it was doing, if Congress stopped doing whatever it was doing, and we just let the system go, I think things we would have a deflationary vortex or downdraft, right? Where there's so much, this everything bubble, right? There's just been so much deformation, and largely to the upside of pricing, that if left to itself, the system would want to clear out all of that excessive valuation and malinvestment. We would have a ton of debt defaults rippling through the system, right? Mm-hmm. Interest rates would probably go even higher, who knows? But there would be this process where the system would finally say, okay, God, I can get rid of all of this dumb stuff that's not supposed to be around here anymore. Right. And we would have tons of bad loans go into default. We'd have a bunch of zombie companies die. We'd have, massive asset price repricing downwards, whatever. And I think you can kind of look at everything that's being done then. Everything being done by everybody who has a hand in running the system is trying to avoid that. I think until recently, they were trying to avoid it from happening at all, just living in the fantasy land of, hey, maybe we're in this new frontier where we can just always keep things, elevated and we've won out over market forces.
Right.
I think now the Fed, I agree with you. I think it's doing the right things right now, but I don't think it was because of intelligence on the Fed's part. I think the inflation monster just got so damn big. They're saying we just have to do this, right?
Right.
And so now I think they're shifting from we can't keep things elevated all the time, always heading higher here, but now we want to avoid the deflationary vortex, right? We don't want this all just cascading in a deflationary waterfall tomorrow. And maybe we hopefully can engineer this sort of soft landing and then get everybody happy and then get back on our way to growth again. And we'll keep pulling our little levers the best we can. So that's sort of how I look at the system right now. Do you share that kind of outlook, or do you see it differently?
100%. I think what we can't pass over is how hard that soft landing is. It's virtually impossible. Right. It's like landing a 747 on an aircraft carrier. It's not going to happen.
At night in a storm.
At night in a storm. And, it's not going to happen. So the question is, how bad will it get before the Fed starts pulling its levers again? And I think that's the question. Interest rates the economy is doing okay. Shockingly, it's doing okay. We get a round of jobs data next week. That's all expected to be really good. 3.5% unemployment rate is the expected rate. That unemployment rate has almost never been seen in the last 40 years. I mean, it's crazy. Jobless claims, which come out weekly, have been solid. They've been ticking up a little, but nothing concerning in there. We just had positive GDP growth, which is very flawed. And we can talk about that later, but it's not what it appears to be. But either way, the economy is not tanking. The economy probably is flattish for the year. So what we have to look forward to is these interest rates, the ones from March, April, May, June, all of those slowly hitting the economy. We're starting to see it in the housing market. Some of those high-flying markets are getting hit hard now. Down, I want to say it was San Francisco, but somewhere on the West Coast, down 20+%. But the problem is they were up 30%. So yes, you're bringing them down, but you're still not even at, close to the pre-pandemic levels.
Right.
So there's a lot of pain that has to happen. And that's why I think a soft landing is nearly impossible. I guess the other thing that maybe they can engineer is a landing where they don't actually touch the ground, where they just say, okay, 3 to 4% inflation is good enough for us. And we're going to start pulling our levers out at that level. But that has a whole different implication for interest rates and how businesses and consumers' outlook on the future would change. So I'm not expecting that one.
Okay. Yeah. And that one, we've talked about that a bit with past guests like Bill Fleckenstein, who basically says if the Fed, because that would almost be an early pivot, right? A pivot before they can say mission accomplished.
Right.
And Bill Fleckenstein and a few other folks that we've interviewed have said that's when it could really lose the bond market, where the bond market could say, look,
that's the risk.
You're not going to get inflation under control. You've just shown that you can't. Therefore, we want higher yields to compensate us, right?
Right.
All right. So just to continue going through here, you had talked about with one of the dangers of inflation is that it becomes a mindset, right? And that the Fed is really trying to get out ahead of this, which I think we all think they should do, right? The inflation mindset isn't a helpful one. And I don't think the mindset has arrived yet the way that it has when you look at, past bad periods of inflation where people start like rushing out to spend their paychecks because they're afraid they're going to buy less, literally next week.
Right.
And of course that pushes, prices a lot higher, a lot faster. And that's the vicious cycle you get stuck in. But we are seeing it a bit in wages, right? We're seeing people demand higher wages. We're seeing while the unemployment rate is still so low, I don't believe the official unemployment rate, but I will say on a relative basis, we're still on the low end of the scale. So nominal wage increases have crept up. Now they're still actually declining on a real basis. So even though workers are getting higher nominal wages, they're actually still getting further behind, which is awful, right? And that's why inflation is such a bad thing.
Right.
But I part of me wonders, I understand why that's happening today. I look out with my recession goggles on and say, I can see pretty good potential for, a pretty serious recession coming up. One where I could see there being a fair amount of layoffs associated with it. And I'm just trying to think, how do you get kind of the wage price inflation danger in an environment where employers are basically shedding jobs? So I wonder if a recession isn't necessarily going to kind of nip that wage price inflation concern in the bud.
It will, absolutely. And the Fed has told us that. The Fed has told us they want higher wages. I think here's the problem a lot of people have, and I like to, when Lance and I talk on his podcast, I bring up my brother. He runs a printer. He's a printer here in Maryland, 40, 50 employees, something like that. They have struggled mightily to hire employees, especially the last few years. And he was complaining to me one night about this employee that's really quirky and not good at her job, and going on and on about this employee. So I said, why don't you fire her? He goes, and replace her with what? I can't find anyone. He goes, I can't find convicts that will work for me. So, if you put yourself in the shoes of a small business owner, a medium business size owner, my guess is they're going to keep those employees that aren't very good, that are quirky, that for whatever reason they don't necessarily like, and they're going to lay off middle management or upper management. So, you can, because you lay off, if he lays her off, he can't replace her. So, and I think that is throughout the lower rung of the economy. So I foresee a recession where the unemployment rate doesn't get too high, where layoffs are not what they typically were, but it's because they're laying off one person making 300,000 as opposed to 10 making 30,000. And that will be a really interesting twist, because that, again, kind of getting back to the same point, is going to affect the middle and upper classes, not the lower classes as much.
That's interesting.
How many times have you been to a restaurant where there's tables, but they can't seat you because they don't have enough waiters, waitresses?
So yes, but here's my question. So I totally get how we got to this stage through the pandemic, right? Where, we were doing pretty well economy-wise and employment-wise up to the pandemic.
Right.
Pandemic hits, we shut everybody down, but we basically send a bunch of stimulus money out to folks, and we give them reprieves on, evictions and having to pay their student loans and all this stuff, right? And we shove a bunch of PPP loans in the system so employers still can pay people, right? So people's relative prospects, I'm going to guess, went up through there if you're lower labor, right? So the question is, it's almost sort of, in my mind, it's sort of a pig through the python question. It is, how much of the excess is still around right now? And I've seen differencing of opinions. I actually almost brought a chart for this discussion, which a Harvard researcher was calculating how much he thought was still left. And it was still seemed to be like a pretty substantial amount. When you look at the excess savings we have, and now as of mid this year, we're now in a savings deficit. That's one of the things I was going to talk with you about here. Here's a headline from Zero Hedge: Americans' savings rate plunges near record lows after inflation overwhelms income growth. Right. Nothing surprising about that, right? So, and if we look at the revolving debt figures out there, right? We were near a record high or at a record high right at the pandemic. Then people paid off their credit card balances as they got those excess funds. But that bottomed, and now we're back up to record highs. We're growing at a record pace now. So people are funding more and more of their lifestyle on debt, right?
That's right.
So where I'm going with all this is so you had those excesses that let people be more choosy. But now you've got, inflation and the cost of living. I mean, food inflation is ridiculous right now amongst gas and other types of key essentials of living. So at some point, once that excess is gone, those people are going to feel a real pinch. At some point, they can't be choosy because they actually have to pay bills, right? And if we get a recession where, a lot of the current job openings get shuttered and there's less competition for these folks, in my mind, I think even at the lower end of the level, it's going to have to tip where these people are going to be like, okay, I had like 3 employers who were competing for me, and now I have 0. So, I can't be choosy anymore. Yeah, I'm willing to start discounting what I'm willing to accept.
I think
I don't
that's
see
a
how we
fair
can avoid
argument.
that, but a lot of people seem to think we can.
I think that's a fair argument. But then you have to focus kind of too on the bigger macro picture that's going on. Trump and now Biden are both have very similar immigration policies. They're really trying to different degrees cut back on immigration, right? So they're cutting back on available workers, especially at those lower rungs. At the same time, we're deglobalizing. We're trying to bring manufacturing back to the US. Those are all low-paying jobs. So from a more broader macro perspective, we have an increased need for labor and not an increased amount of labor to fill those jobs. So, I think this macro effect is already starting to hit. We saw it in Biden's, whatever he called it, the inflation killing bill. They're trying to bring back some of these key industries back to America. And it's not clear to me that we can bring them all back and find employees to work them. So, globalization was a wonderful thing for this country. Deglobalization is not going to be such a wonderful thing. We unlike China, we can't pay workers $2 an hour. We have regulations. We have things like OSHA. We have restrictions, and it costs a lot of money to have an employee. So, the fact that we don't have enough, we may not have enough employees to work those lower level jobs, or quite frankly, people that want to work those lower level jobs is going to be a problem. But all of that is inflationary too. Right.
I totally agree with that. And it's funny, part of me is glad to hear that we're bringing back some of these manufacturing jobs and actually making stuff here. You're right, is we globalization gave us the ability to have a highly efficient and highly cost efficient global production system, but it had no resilience. And it really kind of hollowed out our economy, right? We became a financialized economy where we didn't really make things here, right? So there's a lot of things to cheer about onshoring or reshoring stuff. Of course, there's friendshoring, right, where a lot of those jobs may go, say, to Latin America or whatnot, right, where they're geopolitically in a safer, more friendly place for us, but they're still lower cost. But I don't think we've really seen the manifestation of what you and I are talking about here yet, right? Like those manufacturing jobs, they're not hiring for those people just yet. It could be wrong, but I don't think it's really started yet. That's in the future. So, I still look at the current situation where, we hear employers saying, yeah, I can't really hire anybody good, right? I just don't see how that persists through next year, just given where I see the macro trends going in terms of margins compression and companies needing to get rid of the dead weight and consumer spending coming down still, and cost of capital going up, which means we can all do less.
But what you're implying is that there's a pretty deep recession.
I am, and maybe that is just my bias, but I don't see how we avoid that. Yeah.
I think you are correct. And I think you are correct on the labor situation will sort itself out, just like inflation will sort itself out if we have a deep recession. And I think, I bet if we were at the boardroom at the Fed and we could hear what they really think, they may say that we need a deep recession. They may be saying the same thing, but they can't say that publicly. They've already said things out publicly that have shocked me.
Right.
That
the fact that Jerome Powell used the word pain. Yeah, that, and the fact that Jerome Powell said this is going to involve some pain. Like that's as close as a Fed chair will ever say to, we may cause a recession.
Well, here's a little bit off topic, but I think also what's interesting is the administration hasn't been fighting Powell. They're kind of letting Powell do his thing. Now, maybe behind the scenes,
at least publicly, yeah.
But we haven't heard any rumors that, Biden's on him or anything. So it just leads you to think about what's really going on here. I think there's a lot of things at play, and it's sorting all this out. Some of it is just very localized to what's going on right now with inflation. And I think there's longer term, bigger picture things that are happening here Biden, I mean, Powell is single-handedly going to take the House or Senate or both away from the Democrats, and Biden doesn't visibly seem upset with that.
Yeah, and it's funny if you compare Biden to, say, Trump. Trump had absolutely no problem
Powell
lobbing
would have been
grenades.
fired a long time ago.
He had no problems criticizing publicly.
Right.
It is interesting, and I think that's probably a big difference of style. I personally suspect there's probably been a lot of pressure all year on Powell to do something about inflation,
right?
And then recently, I mean, it's hard because what do you want? If you're Biden and you're trying to be manipulative here, what do you want to ask Powell to do here, right? Do you want to ask him to pivot and go back to easing, because then the inflation problem is just going to get worse, right? So it is a tricky position to be in. I am curious though. The pessimist in me suspects that there has been a lot of propping up and window dressing of whatever they could do just to try to make things look as good as possible, even though they don't look that great leading up to the election. I'm curious what might be removed after the election is gone, where they don't need to be propping stuff up anymore. I mean, do you expect any sort of shoes to drop that were just being held up by duct tape, until
I don't
next
know.
week?
I think if anything could have been propped up, they would have made the inflation figures lower somehow. They clearly were not able to affect the inflation numbers. I think those would have been much lower. So I don't think so. Now, I think what we do have to understand is, assuming the Republicans take one of the two houses, if not both, the odds of fiscal stimulus
go down.
And that's a big deal as we potentially head into a recession. Now, doesn't mean that if we're in a recession that they all seem to vote the same way anyway when we get big funding bills like that. We saw that in, we can blame Biden all we want for 2021, but he was following in Trump's footsteps. So this is both parties that are playing the same games. And I think when push comes to shove, we can get both parties to agree that they need to spend a lot of money and win votes for themselves. But it's going to be much harder.
Right. The pain will have to be
more severe than it otherwise would have been.
Yeah. Yeah. It'll be interesting because the markets tend to like gridlock, right? Because it just means, hey, we've got more confidence in what's going to happen going forward. It's going to be nothing because there's gridlock.
Right.
But I wonder on the net, result, would they prefer gridlock, or will they be disappointed that the likelihood of fiscal stimulus is now so low that they're going to place a discount factor on it?
And that may be something to deal with tomorrow. That may be when the market starts sinking again, the economy is clearly in a recession, that we feel the effect of that.
Yeah. Well, what's interesting, you mentioned the Bank of England. We've let the camel's nose under the tent in terms of what can be done with fiscal stimulus, right? And what was interesting about what happened in the Bank of England that you were talking about earlier is it was an instance where the monetary policy and the fiscal policy were at odds with each other, right? Where the Bank of England was tightening. It I think literally like that day or the next day was going to give a press conference on how it was going to start begin to put quantitative tightening in action. Right. And then, Liz Truss, the prime minister, who is no longer prime minister anymore, she put forth her mini budget, which had these big tax breaks in it that nobody knew how we're going to get funded. And so you had the Bank of England pumping on the brakes while Liz Truss and her administration were trying to put their foot on the accelerator, and then chaos ensued, right?
Right.
And so what's interesting is now DC may have learned the message of, bad economic crisis. Well, we just flood everybody's, mailboxes with checks, right? So even if the Fed is trying to engineer something else, you've now got this emboldened, political system that says, we might not care what you're doing, pal. We got to look like we're doing something, so we're going to do this.
Yeah, the problem with that theory, though, is the reason they could do it in 2021 is because the Fed was helping them. The Fed bought almost $7 trillion in not treasuries, but in assets. So the Fed indirectly absorbed everything the Treasury was offering. If the Fed was not absorbing what the Treasury was offering, yields would go sky high. There's no one to take that paper, or at least not at back then 1-2%.
Back then, yeah. And I asked this question more or less to Joseph Wang, and his answer was more or less, there are other buyers of Treasury besides the Fed,
Right,
and
but
Congress.
at what price though?
Yeah, but in a crisis, they don't care.
That's fair in a
These guys don't
crisis.
do math.
But 2021 wasn't a crisis anymore. There's a big difference between March and April of 2020 and March and April of 2021.
Right. Well, but yes, but with 2021, are you thinking mosely about the latest bill that was passed?
Yes.
Which squeaked through basically because of the horse trading with Manchin, right?
No. 2021. 2021.
Oh, you're right.
Was the second round of stimulus.
You're right. Yeah.
That the Fed completely basically abetted. They were in the getaway car, ready to go.
Oh no, I completely agree that the Fed has been an enabler to date. I'm just wondering if even if the Fed isn't on board.
That's why I'm saying if the Fed's not on board, it's going to be hard for markets to absorb that much. Yeah, yes, in the crisis, but at the end of the day, the crisis doesn't last that long. So the crisis may last a month. You can measure it in months, but at some point there become other places to buy, other assets to buy, and Treasury prices have to compete to some degree, meaning yields have to rise. And look, there's always going to be buyers of Treasuries. That's not the problem. The problem is at what price.
Right. And I agree with everything you're saying. I guess my worry, which you don't have to share, is just that we don't have economic geniuses on Capitol Hill. And so, they may not care. Oh, so what? Treasury, we're going to sell these and the market's penalizing us with some extra yield. All right, I don't care. Like, let's just do it. It makes my constituents happy today. And
right.
If that debt ever becomes a real problem, hopefully the guy who takes my seat, once I'm done, that's his problem to deal with.
Right. That's typical DC. You should move out here.
Yeah. And you're right. There may be other constraints that really prevent that from happening. I mean, I guess if it was easy, that would have already happened to date.
Right.
But I will tell you that Joseph was very almost sort of nonchalant about like, oh yeah, the Congress almost has its own free printing press and just being able to issue treasuries. Because I was probing a bit in the way that you are. But also too, I do worry that sort of the mindset has shifted where they now know it to be possible. Might not be wise or prudent, but they know it to be possible.
That's looking back at what happened over the last few years, that's my biggest concern is we taught them a new tool, or they taught themselves a new tool that they didn't know they had. And they can basically let that inflationary dragon out of the basement whenever they want now, for better or worse. Now, and they'll get cute. They can say, we're just going to let a little baby dragon out. We want to get inflation from 1 to 2%. And like a soft landing ain't going to happen. So it's scary.
It is scary. And it just, maybe we got to our rant early today in this, but I see the potential for, we had the divisiveness of, like the student loan forgiveness, right? You could be for it, you could be against it, but it definitely was a divisive decision, right? Where not everybody agreed with it. But and the skeptics look at that as sort of, hey, vote for me, giveaway, right? Mm-hmm. Like, hey, if I give away, if I forgive debt for all these people, I'm just ensuring that hopefully they're going to vote for me in the next election, right? So why not do the same with just direct checks? If you're the party that's in office, why not when the next election's coming up, you come up with a little mini dragon program like you're talking about, and you put whatever packaging around it. It's the food relief bill or whatever, right?
Right.
And everybody gets a little check in the mail 2 weeks right before the election, and lo and behold, that improved their sentiment towards you.
And who fought to have his name on the checks?
Right.
Donald Trump wanted his name on the check, which it was always the Treasury Secretary whose name goes on the check. He wanted his name on the check. That just tells you. And this isn't pro-Trump, anti-Trump, pro-Democrat, anti-Republican, you name it, whatever political party you believe in. This is politicians being politicians and buying votes. And that has gone on in every country and every party in this country for hundreds of years now.
All right. So, all right. Well, we made it through the first bullet on my list of things to talk about, which has been great. This has been a wonderful discussion. Um, well, first let's talk about the Japan blink for a second because it's
Mhm.
germane to what we're talking about here, and then I want to get to a couple of questions about the FANG complex because I think we're seeing some things going on there that are material, maybe milestones on where we are in this larger story with the bear market. But for those that aren't aware, the Bank of Japan has had. I mean, if the Fed painted themselves into a corner, the Bank of Japan is pretty much, crazy glued, power hammered themselves to the wall. I mean, whatever you want to say, but these guys have really created a prison of their own making over there. And they have been basically trapped with the decision of, okay, what do we want to do here? Do we want to keep rates in control in our credit markets, or do we want to protect our currency? And to date, they have been choosing yield curve control, and the yen has just plummeted over the year versus the dollar. Lots of issues. Japan's in a really tough spot. And because of how badly their currency has suffered, inflation's becoming a really bad problem inside Japan right now from a purchasing power standpoint, from
Right.
folks buying regular goods. And so the Bank of Japan just announced that they are going to give 200 billion in stimulus to the public.
Inflation relief.
Yeah, it's an inflation relief, right? And so basically, this is trying to put out a fire by pouring more kerosene on it, right?
Right.
So it's the most boneheaded decision in the world. It's got to be purely political, just because politicians need to look like they're doing something, right? But it is exactly making the problem that they're reacting to even worse, right? So it sort of shows that a lot of the world's central banks, their option set is just getting worse, right? We talked about what happened to the Bank of England. Bank of Japan's here in even a worse space. So, what is this telling you?
That we're not the only ones. That this is a global problem, and it all boils down to the use of debt and the use of interest rates to foster more debt throughout the world. It's every country has variations of the same problem. They took on too much debt and they tried to, instead of letting some of that default, which is natural and should happen, they supported it. They not only help people pay off the debt with lower interest rates and things like QE, but they encouraged more debt and zombie companies, zombie borrowers. And you know what? You look at Japan and you say, wow, we're really lucky to be in America. What a mess they have. They're trying to fight inflation with QE. I mean, it's crazy. They're trying to keep their 10-year rate pegged at 0.25%. And the reason is because they know that if their 10-year rate gets to 1-2%, I don't know what it is, their economy goes bye-bye. That's it. There's
Because
just too
there's so
much
much
debt.
damn debt there. Yeah.
Right, right. Now, at the same time, they have an inflation problem and they're still doing QE, and they have a currency problem because the Fed, all the other central banks are varying degrees of hawkishness and they're being dovish. So why would you own a Japanese bond at 0.25% when you can buy a 10-year US Treasury higher credit rating at 4%?
Can I just interrupt you for 1 second? So
Yeah.
they have a deflation problem, right? They've been trapped in deflation since the 80s.
Mm-hmm.
They now have an inflation problem, and they have a currency problem.
Yep.
I mean, it's
right.
almost like you can't even, you'd have a hard time having imagined something that
And
crazy.
right. And I think their inflation problem has got to be worse than it is. Their inflation, I think, is only running 3.5%, which, that compares to zero-ish for the last 20 years. But what's amazing to me is that they import a lot. They import a lot of stuff. They just don't have, they don't have the fields. There's a lot they don't have as a natural resource wise. So if you just think about oil, we pay for oil in dollars. The price of oil is in dollars. So when the price of gas goes from $3 to $4 at the pump, It's in dollars. We never have to convert it. In Japan, they're buying that stuff from somewhere else. So not only is the price of gas going from $3 to $4, but the price of the dollar went up 20%,
Right.
which you can tack on to the whole thing. And that's going on across most of the food complex, energy complex, and various other items that they're buying.
Right. Because they have very little domestic production because they're an island nation. They have to import just about everything.
Do they have any? I don't even know if they produce
I'm
any
sure
energy.
There's some Japanese farmers in the countryside, but
food, yes, but not energy. I think is next to nothing.
Yeah, they're firing. Well, that's why they're firing their nuclear fleet back up again.
Right.
But yes, I mean, in general, they import vastly more of their inputs than the average nation.
Right. So if you look at causes of our inflation, they have those same causes plus 20 to 30% purely because of their currency.
Yeah, it's crazy. I'm just I'm trying to think of an analogy, and this is a terrible one, but it's like a ship at sea that is sinking because it has holes in it, but it's on fire, right? But also someone's strafing it from an enemy ship, with bullets at the same time. I mean, you just have like a triple threat that they're
and two dragons.
Any one of them would be pretty existential, but all three together.
And two dragons breathing fire all over it.
Yeah, it's
gotta get our dragons back.
It's almost comical, but it's sad because it's so tragically serious.
And a demographic time bomb.
Yeah. So I used to work for Yahoo and their mobile group back in the day, and we used to say that you could travel to the future. You could get on a plane and you could travel to Japan, and you could see where America's mobile ecosystem was going to be in like 5 years' time, because Japan was so advanced on the mobile side of things. And I think very sadly, I think you can make a similar analog here, where we can look at Japan and say, if we continue pursuing the policies we are, Japan is showing us where we're going to end up, right? They've got this massive deflationary monster, the dragon, that is, still probably the biggest baddie on the block there. But they're now dealing with, an inflation dragon at the same time. They've got really unfortunate demographics, and they are basically, in many ways, just America, just kind of time shifted.
Yeah, I mean, it's a sinking ship, and there's no way. Yeah, I don't know how they get out of this. And the question is, does it matter? As U.S. investors, do we care? Japan isn't what they were, but they're still the fourth biggest economy. Them and Germany are kind of right around 3 or 4 trillion, well behind China, which is well behind the US, but they're still a major economy and major producer of a lot of goods that we're dependent on. So, and they're one of our best allies.
Right.
So I don't know the answers to how you deal with China, but it's got to be a hard landing. They can't keep avoiding landing. Gravity eventually has to work.
Yeah, with Japan, it's always been the bug in search of the windshield, right? And maybe they're finally finding that. But to the big part of your question is, it's not just Japan, right? I mean, if Japan were to suddenly just evaporate from the world map, it would be injurious to the U.S. interests in the way that you're talking about. But there's tons of other countries out there that are experiencing this, and in some cases even worse, right? You look at the Sri Lankas of the world and you're like, oh, okay, well, that's like basically becoming a failed state.
Right.
But I mean, you just look over at our allies in Europe. I mean, they're having a really tough time. They're not Japan yet, but they are not having their best year, by any stretch right now.
Right.
And it's very unclear how they get out of the situation that they're in right now, without some sort of peace being stricken with Russia and some sort of resumption of global energy flows and whatnot, right?
Yeah. The world is a tough place right now, and it's a lot tougher because of all this. Everything we've done for the last 40 years has made the situation much worse than it needs to be. And a lot of this is just fake wealth, and we have to get rid of the fake wealth. And
so you're putting your finger on the point I mentioned earlier, which is if we just let the system be itself, it would correct to the downside by getting rid of all of this malinvestment, this fake wealth that you're talking about. I mean, that really is what it is. We call it a too much debt problem, but really what we have is we have too much fake wealth in the world right now, and we just are desperate not to realize that fact, because
Right.
if we do, that means a lot of what we currently think we have, we don't.
And I think if you said, okay, well, what if Adam and Mike were president and vice president, what would we do? And we have this balloon, and how much air do you want to let out at any one time? And I think we'd fall into the same trap. We can't let all the air out at once. We got to just slowly let it leak out. Maybe the two of us would let it leak out a little quicker than the powers that be right now. But it's just going to take a long time to let that air leak out. And that air leaking out is a very painful process.
Yep. Yeah. And I mean, a lot of people like to cavalierly say, screw it, let's just let the whole thing burn, and then we'll pick ourselves out of the ashes and go. And to be honest, that's probably, like, if you looked at the grand scope of history, we'd look back in 50 years and say, wow, glad we did that, and we got to the rebuilding phase early and whatnot. But the human cost of it is so damn high that no politician will ever sanction the fast and immediate way there. But I wanted to really underscore that, because that is the problem that we're facing, right? Is we're facing, our biggest opponent here, I think, is sort of fantasy or magical thinking, right? Is we are still acting and behaving like the wealth we have is real, where a lot of it just isn't, and eventually needs to be cleared from the system one way or another. And make no mistake, whether it's by default or whether it's by destruction of the currency through too much inflation, both of those are how you clear malinvestment from the system. They're both painful. They're both defaults in one way or the other, right? So you kind of can't avoid the default. You just have to sort of pick your poison. But where I was going with all of this is if we think that there is a risk, which I think you and I both share, that we will eventually have to have our day of reckoning here, in the US, which is still one of the best positioned players on the chessboard, collapse happens from the outside in, right? And so as we see weakness elsewhere, it's a sign of progression towards the core, right? So we need to be paying attention to it, because it sort of tells us how close we are to the point where we're really going to have to start taking our lumps. And to be honest, we're talking about Japan and Europe having really tough times right now. Those were two of the stronger players on the chessboard. They still are on a relative basis.
I mean, the UK had the reserve currency 70 years ago. They were the world's powerhouse too at one point. This is inevitably, you're right, all this is coming home to roost. And these are all previews of what to expect in various degrees, various parts of the movie. Japan's towards the end of the movie. Some of these other countries are towards the middle of the movie. But they're all variations of the same problem that are all coming home and putting pressure on ourselves.
All right. Well, look, sorry, folks. I didn't mean to get so dark on you.
It is Halloween.
Well, as we begin to wrap this up, I do want to ask you in a minute what trades RIA has made over the past week, if you know, Michael. But before I do want to ask this question about the FANG stocks. 2022 has been a bad year for the FANGs, their first bad year in forever. These were the darlings. These were the bulletproof companies, right? Let me just read some numbers. So Meta, which used to be Facebook, it's down 70% year to date. I don't think anybody could have imagined that, going into this year at the end of last year. It was down just on Thursday, it was down 22% after disappointing the markets with its earnings release and its forecast. Amazon is down 37% for the year, and today it's down 8%. Right. So having a bad day today. Google's down 29%, Microsoft's down 25%. Those were both down 9% and 8% respectively on Wednesday with their earnings disappointments. And Apple is still kind of bucking the trend. It's up 8% today, so it's having a big day today. Still down 9% for the year, which is pretty good relative to all those numbers I just mentioned in the general markets. Right. But of the fleet of FANGs, it's really the only one that hasn't really stumbled hard yet this year. So my question for you is we've talked on this program a lot about how these companies have propped up the prices of the major industries because they're so big and they're so over-owned across ETFs and institutions and whatnot. And so the thesis has been, the markets will be more resilient than many bears expect until these generals stumble. And it looks like we're seeing the generals begin to stumble here. So first question is how material is this weakness that I just rattled off here, in your opinion?
It's material. I mean, these are huge declines for massive companies that you're talking about. But I think one of the more fascinating things is if you would have told me what was going to happen this week with some of those bigger names, the market's going to be much higher in the week. I'd say you're
crazy. Isn't that crazy?
You're crazy. But the fact of the matter is there's 490 other companies that also make up the S&P 500 that have more than offset the losses in all of them but Apple. So, and Netflix has actually been doing well. Officially, they're a FANG for some reason. They don't have, nearly the size of those other companies. But
okay. But well is a of late factor for Netflix. They're
right. Of
this
course,
year too. Yeah,
of course. So maybe what we have is what I would call, I guess, a rotating bear market, where various parts of it get hit. Like you look at the Cathie Wood's high growth, high tech, technology type companies. Those things are down 70, 80, 90% in some cases. They're washed out. They're not getting killed anymore because they can't. And there's a lot of value out there. So maybe what we have is not necessarily a bear market, but just a rotation. They're moving from FANGs to value, from FANGs to small caps. They're shifting money, but money's not coming out of the market per se.
Okay. I want to interrupt you there because actually this is the point I wanted to debate with you. So I hear what you're saying. There's a part of me that's suspect, and I'll tell you why, which is for a long time this year, I've heard from a lot of different sources, hey, you look at the average company in the S&P or the NASDAQ, it's down way more than the indices, right? And the rationale for that was because of these big companies, right? Mm-hmm. That they're just responsible for so much market cap.
Right.
So there is a part of me that's a little skeptical that, yeah, even if everybody else rises a bit here, it shouldn't be able to overwhelm the downside from these big guys, because the big guys' upside minimized the downside of everybody else as the year went on, right? The math should even out at some point. Now, regardless of what I think, the markets are up this week, even despite what I just mentioned, right? So that's what matters, right, at the end of the day. But I want to combine this to something with that Bill Fleckenstein, again, mentioned on this program, which is, he calls it the giant mindless robot. But he says, with the move to passive investing and passive ETFs and how over-owned these FANG stocks are, when capital comes into the market, so much of it goes directly to these few companies, just algorithmically, right, because math. The funds have their allocation. It's just, okay, I've got to put 15% in this company, and right. So as capital comes into the market, these companies have continued to be propped up, right? Because it's going disproportionately into them. And the concern is if we ever get to a part where capital is net coming out of the markets, you get that thing working in reverse, right? And I think that's the risk of the general stumbling, is if we get to the point where enough capital is spooked that we have net outflows, then these guys could really drag everything down along with them, or at least the major indices down along with them.
Right.
So with that on the table, let you answer.
First of all, I think that's a very valid point. We haven't seen capital outflows yet. That's the first thing. So, we have probably capital rotations. If I'm in my 401k and I'm in a big, top 10 S&P 500 type index that's very heavy with the FANGs, maybe I moved it to small cap a few weeks ago. Maybe I moved it to a value fund. So the money hasn't, at least yet, has not left the markets. And look, even if your whole 401k is in an S&P 500 or one of those balance fund, maturity date balance funds, the S&P was up this week. Do you really care that Microsoft and Google and everyone else were down that much? They're not invested in the individual stocks. So as long as the capital stays in the market and doesn't shift over to the bond market, or doesn't just come out of the market for whatever reason, I think the whole passive thing will support the market to some degree. Those weekly inflows from everyone's paychecks will continue. But that's where I get really scared, is when we get outflows.
That's when things get very dangerous. And the amount of inflows has been declining over time, but shockingly, investors have stayed with this. You know, we unlike what we saw in 2008, even to some degree in 2020, investors are not freaking out. And that's what's kind of amazing to me. And whether that's just temporary and will change, we have yet to see. But until the capital actually comes out of the markets, you're going to have these rotations, and some sectors will grossly underperform, meaning that by default, as long as the money stays in the same pool, something else has to do better. There are plenty of stocks that are up on the year. Exxon's up almost 70% this year.
Yeah. They're at an all-time high for the year.
Exxon's earnings were the same as Apple's for the quarter.
Oh, that's amazing. A whole other topic we don't have time to get into. But I did just see a headline right before I hopped on here about, all of a sudden there's now calls for nationalizing America's energy industry, which is a whole other ball of wax in itself. But that, I'm sure that doesn't help, right? When there's a part of the political spectrum that sees these companies as making, rapacious windfall profits during a time of energy insecurity. All right. So let me just ask you this. What do you think, what in your mind are sort of leading candidates to create capital outflows from the equity market?
Bigger downturn in stock prices.
Okay. So people getting spooked.
People getting spooked and just yields.
Well, okay. So if yields are, then let's go there, which is, I just interviewed Jim Grant this week, and he said, hey, stocks, despite being down 20% this year, they still look overvalued, especially when you're looking at how future earnings estimates need to come down.
Yep.
But he said bonds are beginning to look better than they have in a generation.
So I had a number of conversations over the last 10 years, more than a number, that said, if I could just get 5% in a bond, I'd be good. I would just put my wealth in there, earn my 5%, and not care what else is happening in the stock market. Doesn't matter. That's enough. That's my bogey. Well, we're there. You can buy Apple bonds, 10-year Apple bonds, 5%, and you can just go down a little bit in credit and buy 6%, 5, 7, 10-year bonds. So the question is, when will the yields be enough to entice people to say, screw it, what am I doing in the stock market with all the volatility? I'm just going to buy a 10-year, name your favorite company bond at 5, 6, 7% and call it a day. And that is probably the biggest risk at this point. I mean, you can buy treasuries for 4.5%, risk-free, quote unquote. Mm-hmm. So there's competition that there was never competition in the last 10, 15 years.
Right. We had the TINA markets where there is no alternative. You can't get yield anywhere else. You got to be in equities. So now there is. Right.
A couple of weeks ago, I wrote an article, Goodbye TINA, Hello BA, BAAA. Bonds are an alternative.
Bonds are an alternative.
We're into the sheep BA era.
There you go. I like it. Yeah, I was thinking TINA with an extra A, which is there is TINA. Now an alternative. Yeah.
There is. Yeah. It took me a little while to fool around with that and come up with something halfway decent.
Nice. All right. So look, I'll remove the pressure of predicting it's going to cause a further cratering of the equity market. But do you expect capital to start shifting into the bond market given where yields are?
Yeah. Absolutely. Look, I think equities are going to be lower. I don't think we've seen our lows. Never say never, but I don't think we've seen the lows. But we're in the midst of a technically oversold situation that will correct itself. And the way I like to think about what's going on is we're in a trend. And the trend is just, you can draw a 45-degree line, but you kind of have a sine wave that goes around it. Sometimes you go too low, sometimes you go too high. And markets just don't follow straight lines in one direction or the other. Right. They get over and overextended in both directions. And we were very overextended, very oversold. Everyone was bearish. And when everyone's on the same side of the boat, it's never going to work. Everyone's not going to be right. So now we got to shift to the point where everyone's bullish again, where we've seen the market bottom, where the volatility VIX index gets back down maybe to 20-ish. where a lot of technical readings become oversold, not overbought. And that's a process, and that could go on, potentially for a few more weeks, a couple hundred more points on the S&P potentially. But the trend is still lower, especially as long as the Fed is doing what they're doing, and the recession's on its glide path towards the ground. How
right.
Whether it's a soft landing again or hard landing, we don't know how we're going to land, but that's where we're headed.
Right. We know the ground's coming up. We just don't know what the
Right.
impact speed is going to
Right.
be. All right. Well, look, real quick. Do you know what trades RIA made over the past week?
Unfortunately, I do.
Okay.
So it wasn't our best week. We did sell a little bit of Google and Microsoft, which I guess was a good thing. Did some tax loss selling, but we didn't want to give up exposure. So our feeling was that this market still has a little more room to go. And from the bottom a few weeks ago, our goal was to possibly increase equity exposure a little. Granted, we're still sitting on a lot of cash, but we were going to increase exposure a little. And then when we get closer to our target, which a few weeks ago was 3,900 to 4,100, we would reduce exposure beyond more so than we had before. So we reduced exposure in Google and Microsoft. Unfortunately, we wanted to keep our exposure up. So we did some tax loss selling, but didn't want to give up the exposure quite yet because we still think the market has a little more room to run. So the day before earnings, we bought Meta, a small position, a 1% position in Meta. And look, our logic is, and I'm not a big fan of the company, but it's a value stock here. It's got a PE of 10. Its cash flows are amazing. It's got a lot going on for it. The stock was also down 60% before earnings. So it was washed out. Our feeling was that the earnings are probably not going to be good based on what we're hearing from other advertisers, but the market's expecting not good. It's, Facebook is down twice as much as pretty much all the other big boy stocks at this point. So yeah, earnings may be a little sloppy, but it'll hold in well and potentially could rally if there's any kind of promising news.
Right. If they're not as bad as
and the worst part was they weren't as bad. They really weren't as bad, and the stock actually popped higher for a few minutes. And then Zuckerberg started talking, and then investors realized that they're not cutting expenses. And next thing you know, you're down 20%. So we sold that position just as quickly as we got into it. It basically, the other thing was Meta was sitting on massive technical support going into those earnings. So we had a lot going for us with that trade. It just not all trades work out. So you have to know where your risk limits is, have your thresholds, know what they are in advance, understand what you're getting into. And, you can't hit 1,000 in this sport.
No, you can't. And I mean, we laugh because it's bad luck, given what happened with Meta. But what you're demonstrating here is, investing is a game of probabilities. And it's a game of, as Lance likes to say, you're trying to advance more yards than you retreat as you move your team down the field, right? And if your thesis proves out to be wrong, right, then get out, right? And so you guys are exercising that discipline, which is, hey, we had a thesis, and very quickly we realized that wasn't the case, so we're just selling the loser and we're moving on, right? We're not getting to that emotional bargaining of, if I hold on to it, maybe it'll come back a little bit and then I can sell it, right? You're like, no, we knew why we were in it, but we realized that wasn't working the way we thought it would, so we're just done.
And look, Lance and I, neither one of us like the company too much, but we do like its income statement balance sheet. The company is just dirt cheap at current levels, and it is what it is. And look, you have to go through a company, look at their outlook. They're investing heavily in the metaverse. If the metaverse pans out, this company is really cheap, but it broke our rules. We will potentially buy it again, but it's probably going to be at lower prices. So we'll wait for those lower prices and take another stab at it. And, that's the way you got to play this game. The game of football is a great example. You just try not to get sacked. It's okay to lose a couple of yards here and there on a, make it 2nd and 12, but you can't be getting sacked every play. You have to preserve your capital. And we are sitting on a lot of cash. So we're handily beating our benchmarks this year. We're down this year, but not nearly as much as either stock market or bond market. And our goal is to have a lot of cash on hand for when the markets turn around, for when Meta is trading at God only knows what, $60 a share or wherever it's going, to be able to buy those companies.
Yeah, and this is just an important point to get out there, and I've been trying to say this in some of these recent videos, is we have been waving the warning flag about overvaluation for a long time. To a certain extent, I think sometimes people understandably can criticize it as like, well, you guys are just a cult of bears, right? There's no situation where you're ever going to be positive. And the answer is no, we've just been looking at the situation that we have, and we've been uncomfortable with valuations, but we can't wait for the days where we can say, hey, there's some great values to be had here, right? And to be able to get to that day, you have to be watching, what's going on, and you have to eventually say, okay, you know what, I don't know if this is the bottom or not, but I now have a high degree enough confidence that enough value is being uncovered here in this area that it's worth to start putting some capital at risk into it. It doesn't mean you're shifting all your chips from the sideline of the table into the center of the table all at once. In like you just said, this was a 1% position, right? So you're going to dribble in initially. But, the folks that end up doing the best here are going to be those who really successfully execute Buffett's famous, be fearful when others are greedy, and greedy when others are fearful, which just means when you're buying in near the lows, if you're doing it correctly, if you're timing it correctly, it's going to still seem really risky and dark. Like the consensus is going to be, this is the worst time ever to put money into play because, look how far the market's cratered. So we're going to have to be looking at fundamentals. And it's almost kind of like, let's get back to our landing the 747 on the aircraft carrier at night, right? When you don't have visibility in the market, you have to really trust your instrumentation. Mm-hmm. And that's like the fundamental analysis and stuff that you're doing, right? Which is to say, hey, look, it's dark outside still, but our instrumentation is showing us that there's actually some real value here. Now, I'm not saying this is the time. I'm not saying this is a good price for Meta. I am saying it's a much better price for Meta than it was at the beginning of the year when it was, 70% higher, right? So at some point here, like you said, we know the ground's coming up. At some point here, we know that true value is going to be reached. And it's a matter of, largely on you guys' shoulders as capital managers to determine when the time is right and the probabilities are favorable enough to start putting that capital at risk.
Exactly. And there is value out there. For the first time in a long time, we've seen value, and we're making lists and we're checking it twice. And, we're going through all the homework because for the first time in a while, fundamentals seem to matter. And that's a very welcome benefit of a bear market, is that all of a sudden fundamentals matter. So we're looking at a lot of stocks, a lot of industries, and there are some now that are piquing our interest. And there are some that are so washed out. That was our thesis with Meta, but there are some that are so washed out and at such cheap valuations that even if the market declines, they're going to be fine. They're going to drift, maybe
they've
flat.
already pre-crashed.
They've crashed already. They're on the ground in shambles. So let's pick up some of those pieces. And, there's plenty of stocks too that are, like I said, Exxon's trading at an all-time high. AbbVie is close to an all-time high. There are companies, UNH is at an all-time high. We own those three. So there are companies that have been able to weather this storm. Now, whether they continue to weather it, that's a different question. But, just because the market's crashing doesn't mean there aren't opportunities, and doesn't mean you should be in 0% equities. It means you should be sitting on a lot more cash and saving that cash for when, it's just like a sale of anything. Wait for something to be on 50% off at the store versus buying it, at the sticker price. And that's, and like you said, I think you said it well, this is a game of odds. You're trying to create the best odds. No one No one hits 1,000 in this sport. Some of the best players are the guys that hit 550 versus 450, that just barely, get over the 500 line. Slightly more winners than losers, but it's knowing to cut your losers early and letting the winners run. And that's how you make money in this business in the long term.
All right. Well, Michael, you've just done a great job of underscoring why we highly recommend people in this type of market work under the guidance of a financial advisor, a professional financial advisor who understands these macro issues and takes them into account in their portfolio strategy. And as I tell folks every week, if you've got a good one, great, stick with them. They're like literally worth their weight in gold. Right. But if you don't have one, or you'd like a second opinion of one, perhaps even from Michael and Lance and their team at RIA, then consider talking or scheduling a free consultation with the advisors that Wealthion endorses. And you can do that super easily just by going to wealthion.com. It only takes you a second to set one up. It doesn't cost you anything. There's no commitment to work with these guys. They just do it as a public service because they are trying to help as many people as they can get prudently positioned for this type of market environment that Michael just well summarized. All right. So, Michael, I had a lot of other things I wanted to get to talk about with you. We didn't get a chance to, but that's a sign of a great interview guest. We hit a rich vein early, and we just you did a wonderful job with it. One thing we didn't get a chance to talk about was two things. One, I do want to dive more deeply into bonds, whether it's Lance or you next week, and just one for helping demystify people. Not all bonds are created equal. There's sovereign bonds, there's corporate bonds, there's muni bonds. I'm sure you have differences of opinions about all three of them right now. So hopefully next week we can dig into that. Folks, if you'd be interested in seeing that explained, do me a favor, just let me know in the comments section below. If there's enough interest, I'll make sure that we ask that. Second, I was going to talk about the housing market. U.S. pending home sales have now plunged to their lowest level since 2010. Mortgage rates are now above 7% on average. They're up at around 8% out here in Northern California, where I live. It's just bananas. Housing is the prospects for the housing market are just looking dimmer and dimmer by the day. We don't have time to get into that here, but I do want to flag for folks that didn't see it. I did a really interesting interview with a new voice in the financial media space about the potential for a kind of a real big downtrend in the Airbnb and other short-term rental markets like Airbnb, VRBO, et cetera. That's another support for the housing market that looks like it's getting taken out at this point. And as you have desperate hosts who have to sell because the cash flows on their properties have gone negative, that could be a pretty substantial additional force that could add a lot of velocity to a downtrend in housing. So if you haven't watched that yet, I'll put up a link to it right here. It'd be a great video to watch after this one. And folks, if you've really enjoyed having Michael on here, hearing from him, especially if you like having Michael on instead of that guy, Lance, do me a favor and help support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Michael, thanks so much for stepping in this week. You did a fantastic job. You're welcome on this program anytime you want to come on. Look forward to having you back on again soon. And everybody else, thanks so much for watching.
Thanks, Adam.